They say fortunes are built when everyone else is too scared to look, and that's exactly where penny stock traders live. These are the battlegrounds of risk and reward, where a 50-cent ticker can double overnight, or disappear just as fast. But every so often, a few tiny companies start showing real numbers, rising revenues, solid product lines, or even positive cash flow, the kind of signals that make seasoned traders perk up. Today, we're diving deep into 3 penny stocks trading under $4 that are making quiet but powerful moves beneath the radar. One has turned a profit in one of the toughest industries in the world. Another is grabbing market share in the billion-dollar healthcare space. And the third, it's a tiny animal health play that could explode if its tech goes mainstream. If you've ever wondered which cheap stocks might actually have substance behind the hype, this video is for you. Welcome back to the channel where we break down penny stocks with potential. No fluff, no fake pump and dump talk, just research, risk, and reality. I'm your host, and every week I bring you a fresh lineup of under-the-radar stocks that traders are quietly accumulating while the mainstream media ignores them. Remember, these plays aren't for the faint of heart. They're volatile, unpredictable, and sometimes painful to hold. But that's why we love them, because one right call can change your portfolio overnight. Before we jump into the analysis, take a second to smash that like button. Let's see if we can hit 500 likes on this video. Every like tells YouTube that penny stock traders are still out here, still hungry, still hunting for the next breakout. Also, drop a comment below telling me which of these 3 stocks you think has the most upside. I'll be replying to early comments personally. And of course, hit subscribe if you want to catch next week's watch list before everyone else does. First stock is SNDL. SNDL has spent the last few years shedding the pure cannabis grower label and repositioning itself as a retail and consumer packaged goods player in the North American cannabis market. That pivot shows in the numbers. In Q2 2025, SNDL reported roughly $244.8 million in net revenue, a 7.3% increase year over year, and a gross profit of $67.6 million, up 16%. The story to tell on camera is simple. SNDL is trading like a tiny levered bet on cannabis normalization and consolidation. Management is emphasizing retail partnerships, CPG rollouts, and margin improvement rather than pure cultivation scale. Financially, the company has moved to stabilize operating income and reduce cash burn. In Q2, they reported positive operating income after a small restructuring charge, a milestone for the company. The risks are classic for the sector: regulatory headwinds, the uncertain federal legal status in the U.S., and price competition that can quickly erode any margin gains. For viewers who like catalysts, point to retail expansion milestones, new shelf placements for SNDL branded products, and any analyst revisions as near-term triggers. For downside, warn about inventory write-downs, further dilution if capital markets dry up, and the long runway to profitability that most cannabis operators face. Overall message: SNDL is a restructuring play inside cannabis, not a safe income stock, but a story-driven microcap where execution and regulation will decide whether it's a rebound or a trap. The retail segment is increasingly featured as a differentiator. SNDL now operates one of Canada's largest private sector cannabis and liquor retail chains with banners like Value Buds and Spirit Leaf. The company noted same-store sales growth in its liquor business, alongside significant margin improvement in its cannabis operations segment. It also remains debt-free with over $200 million in unrestricted cash, giving SNDL flexibility to invest or acquire without heavy interest burdens. This creates a rare mix of growth potential and financial cushion, something unusual in penny-cap cannabis plays. And stock is Clover Health. Clover Health is a tech-flavored Medicare Advantage insurer that has been growing membership and revenue rapidly while wrestling with margin pressure from rising medical costs. In Q2 2025, Clover reported revenue near $477 million, up 34% year over year and above expectations. The company blends clinical, software, care management, and insurance risk-bearing, trying to make Medicare more efficient through data. If its data-driven care model scales, Clover could convert membership growth into recurring, predictable revenue and improve adjusted EBITDA. Management has hinted that Clover is approaching profitability on adjusted metrics, though GAAP results still reflect investments and modest losses. Key financial points include revenue growth, adjusted EBITDA guidance, and a strong cash position that supports short-term operations. The next major catalyst is the Q3 2025 earnings report, which will reveal whether membership and margin trends continue. Positive surprises in claims control or adjusted net income could shift sentiment. Still, insurance is capital-intensive and cyclical. Rising medical costs, regulatory scrutiny, or weaker star ratings on Medicare performance could compress margins fast. Presented as cheap stock, big risk, a growth at a risk story, where execution matters more than headlines. A key data point worth emphasizing. Clover's Medicare Advantage membership rose 32% year over year to just over 106,000 members. However, the company's insurance benefit expense ratio climbed to about 88%, up from roughly 76% a year earlier, meaning medical costs are growing faster than revenue. This tension between growth and profitability gives you an engaging story arc. Clover's growing fast, but the cost monster might be catching up. If the company can rein in expenses without losing momentum, that could be a turning point for the stock. Third stock is Zomedica. Zomedica is a micro-cap veterinary healthcare company focused on point-of-care diagnostics and companion animal products. It trades for pennies but has a product-driven revenue story that differentiates it from speculative biotech plays. The company's most recent earnings showed about $7.9 million in quarterly revenue with a gross margin around 70%. And in Q2 2025, revenue increased roughly 14% year over year. The diagnostics segment grew more than 80%, while consumable product sales rose over 20%. The bullish case is straightforward. If Zomedica's diagnostic devices gain traction among veterinary clinics, revenue could scale quickly because the companion animal market is expanding and less price-sensitive. The low market cap means even small, absolute gains can translate to large percentage returns. But financial caution is warranted. The company remains unprofitable, liquidity is limited, and dilution risk always looms if new capital is needed. It's a lottery ticket stock. Real upside if adoption sticks, real downside if momentum fades. Viewers should watch revenue growth, units sold, and margin trends in coming quarters. International sales also improved by double digits in 2025, helped by new distributor partnerships outside the U.S., suggesting early progress in global expansion. The company has been cutting its net losses, around $7 million this quarter versus over $20 million a year ago, showing cost discipline. Still, its burn rate remains meaningful relative to revenue, meaning product adoption must accelerate before the balance sheet tightens. So there you have it, 3 penny stocks trading under $4, each sitting at a different stage of their comeback story. SNDL is the cash-heavy cannabis survivor, reshaping itself from grower to retail powerhouse. Clover Health is the risky but ambitious tech insurance hybrid trying to disrupt a $1 trillion healthcare market. And Zomedica? It's the true micro-cap wildcard, a company that could go from forgotten to famous if its veterinary tech catches on.